The market fell, and then it fell some more. Eventually, the Dow dropped 666 points. The average investor simply didn't think it was possible, but these are market forces at work. Sometimes there are corrections. It happens. Those who are investing with margin were really punished in the incident today. Are you prepared for more volatility? You came here for the truth, so let me unveil that for you. Today we're going to look at how the Dow dropped 666 points. Any way you slice it, this is a significant percentage in such a short period of time. US stocks fell sharply on Friday after a stronger than expected jobs report sent interest rates higher. I believe this is of significance because you can see that over the last few years, the Federal Reserve has been notching up interest rates at the slowest pace that they possibly could. And they've been doing so with the approval of the market. The market has been telling the Fed, increase interest rates, please do so, you'll help us out. Just do it very, very slowly. And now suddenly we're being told that that's the reason why the market declined. Well, I believe there are many other forces at work here, but this is the mainstream version. The Dow Jones dropped 666 points to close at around 25.5. This is the 6th largest points decline ever. Now think about that. That is very significant. The market also dropped below 26,000, and it's the first time since June 2016 that it fell at least 500 points. So many significant triggers occurred today. The S&P 500 fell 2.1% and finished off around 2,700. So when you look at the market, you can see for yourself what has been happening. I want to focus on interest rates for a moment. Look at this. This is the Fed funds rate directly from the St. Louis Fed website. And you can see, remember that they set the Fed funds rate within a range. So it's never a precise number, but they have a range in mind. And you can see it's been around, let's say 1.15 all throughout late 2017. And then ever since then, it has been increasing. And today it sits around 1.41. Still, historically, extremely low, right? But we do see an increase that has occurred. It's very clear. And even though we are at a rate that is so low historically, we now are looking at a dangerous policy because of everything that is interconnected with interest rates. We're talking about mortgage rates. We're talking about all these different loans that people have taken out. Variable rates, of course, would be affected immediately, but even those in fixed time frames here are going to have to pay the price eventually. 3 years, 5 years, whatever it might be. So all of those things connected in, I mean, not to mention the national debt. So this is now becoming a very big problem, and they do have an option, and that is to print money. They can force it down if they would like, but they don't really have much room. I mean, look at where the floor is. It's not far down below. It's not going to take much to bring it down. That's a fact. Very quickly, the S&P 500 fell 2%. This is suggesting that the Dow Jones dropped 668. That's the lowest since January 10th. NASDAQ down 2%. Stocks Europe decreased 1.4%. Germany was down. Emerging markets were down. I mean, we're down across the board. It's a sea of red, essentially. Look at this. I found it interesting as well. Nowhere to hide. Stocks, treasuries suffer the concerted sell-off. something not been seen since 2009. Look at that. It's when you see things going back into that time frame, you have to be worried about it. There's always volatility, things happen, that's for sure. But when the indicators pile up, that's when you need to start stepping back and thinking, okay, what's happening here? Personally, I'm looking at this, just putting it on the back burner. What happened today in the market could just be one day. The market can continue its upward direction, but ultimately, if the market is spooked by such a small factor, there's really nothing that should have really brought the market down, you know, based on what came out today. There's so many things. There's 1,000 things that I've shown you here on this channel, but that doesn't get brought out in the mainstream media. We know what's really going on. All right. Looking at junk. Junk isn't so much junk when you look at it in the financial world. High yield bond ETF, it's gone nowhere. They've decoupled since basically the beginning of the year, 2017. The S&P just continued to skyrocket higher. And of course, just like many other indicators I've shown you here, there is this chasm that continues to form in between the two. Yes, there has been a little drop, but in comparison, you are seeing the fact that, yeah, they have been totally on their own ways, and that's not normal. When things are coupled together and then they decouple, you need to start asking questions. Why? High yield bonds, when you see this happening here, seemingly moving together over the last, few days here. This is something else, just wanted to bring it to you. I don't like to get into too many of the technical indicators like this and try to match them up. You can sort of make any chart look the same or look different. I just wanted to bring it to you. If you're into the technical analysis, here you go. That's all for this video. If you found it informative, I'd appreciate a thumbs up. And if you're not already, you want to be one of those 84,000 plus people that are here on the channel, hit the subscribe button. You can do so at probably on your screen below. If you're on your phone, you can do so as well. It will not interrupt the rest of this video. Don't worry, you can click on it. And if you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can flip through these books at Amazon. There are links in the description below. Take care.